Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host Pushpendra Mehta, Executive Writer at CTMfile. Joining me today are Paul Galloway, Senior Director, Advisory Services at Strategic Treasurer, and Jack Large, Editor of CTMfile. Welcome back, Paul and Jack. Thank you for taking the time to share your thoughts with us on topics that impact corporate treasury. It's time to pick your brain and get deeper insights from you on our topics for today, namely payments fraud, automated cash reconciliation, ESG, and TD Securities spotting a red flag in the US corporate bond market. Our audience can read these articles and also research content more deeply by visiting ctmfile.com or by following the links in our show notes. Let's get started with our discussion. Our first story for today is about Treasury maintaining its lead in discovering payments fraud. According to the 2023 AFP Payments Fraud and Control Survey, 65% of respondents report that their organizations were victims of attempted or actual payments fraud activity in 2022. Despite this figure being lower than the fraud reported in previous years, payments fraud remains a significant concern for treasury and finance professionals, with 2 out of 3 companies continuing to fall prey to fraudulent attacks as per the AFP survey. Cyber criminals are invariably a step ahead of corporations and they rely on the weakest link in the chain of events leading up to payments fraud. That is, your employees. Paul, in the light of the concerns surrounding payment fraud, should organizations provide specific payments fraud training to employees? For example, courses like SecureTreasury.com that is separate or distinct from general cybersecurity training to help detect fraudulent payments quickly, as well as help Treasury maintain its leadership in discovering payment frauds.
Organizations absolutely should do that. Employees are a weak link. It's something where the landscape of what fraudsters are doing is continually changing. They never take a vacation. They're constantly at work. So the best way for corporations to tackle this issue, and it is an issue, when you got 2/3 of respondents in this survey are saying, hey, we've been attacked or we've been a victim of fraud. It's continuing to happening. We haven't really seen that overall, if these numbers have changed in terms of breadth. What we have seen is the tactics that are used change. And as they change, corporations need to be prepared for that. And the best way to do that is to train your employees so that they understand what the types of fraud are that are out there, so that they understand how fraudsters will prey on employees to extract cash from the company, whether they're using business email compromise, whether they're using social engineering or other types of tactics. They continue to evolve that and come up with new ways to fool employees to thinking that what they're doing is something that's legitimate when in fact it's not. Having appropriate processes in place, having procedures that are not just written down on paper, but are followed, put into action, and to have training in place that is regular in cadence. It's not something that, we've done it once, we don't need to do it again. You have to do this annually. It needs to be something that covers the breadth of the types of payments, because it's not just Treasury that's executing payments. It's other places within an organization that execute payments. They send checks, they send ACHs, they send wires for various things. Now, Treasury typically has responsibility for that in terms of a corporate cash, but they don't do everything within an organization. And many times you can go to Treasury departments and ask them, well, what are your flow of payments? And they'll say, oh, we've got, these 10 different flows. When in actuality, it could be up to twice that many flows if they did a full assessment. Because there are areas within organizations that Treasury may not realize, hey, they have control over cash or control over making payments. And it's something that's not known. Treasury, as a superintendent of payment security, absolutely has this duty to ensure that employees throughout the organization have appropriate training and understanding of what potential risks are associated with fraud. When you think about in terms of recovery of funds or finding where fraud has been detected, Treasury's at the front line, and nearly 2/3 of all detected fraud comes from Treasury's review of cash payments. Another area which is about 40 or so % of the total detection area is your AP, followed by about 25% of all companies are recovering a portion of their funds. So they don't recover it all. So if something leaves the organization, having the ability to detect it sooner will help them ensure that they have some opportunity to recover the funds. So speed is of super importance. If you think something doesn't seem right, you need to say something. So your Treasury team needs to have the support of their leaders in terms of saying something. If they recognize something that doesn't seem quite right, they need to be able to feel comfortable enough. It doesn't matter if you're the lowest line level of employee on the Treasury team or within the organization that, is reviewing or seeing payments. If you see something that is not right, speed is of essence, and you need leadership that supports them coming forward and asking the questions and saying, hey, something doesn't feel right. Is this a good payment or not? The training is super important. The ability to say something when you see something and do it quickly is going to help organizations when they do get fooled by a fraudster recover funds.
I agree with all of that. For me, the most important thing out of this AFP survey, the last annual survey, is that it's ongoing training. It's not just once a year. It's ongoing. And increasingly, I've found companies having news sheets on a regular basis going to everybody in the organization, not just Treasury people. That's the one thing. And the other thing is that the organizations need to accept that they need to look outside of the normal behavior. So, for example, if somebody doesn't have a holiday, keeps on not having holidays, you need to ask questions. And it doesn't matter if it's a senior person or a junior person, you need to ask questions. That's the other thing I took from this work, is that they need to ask questions at all sorts of levels throughout the organization.
The ability to, or having the opportunity, or to feel comfortable in the opportunity to say something will certainly make a difference. And it's all levels, like you said, Jack, within the organization. If it doesn't feel right, doesn't look right, doesn't seem right, say something, because it could be the difference between recovering funds or preventing funds from going outside of the organization's control to losing it.
That's very useful advice, Paul and Jack. Moving forward to the second story, which is up for discussion today, is about modern Treasury announcing its expanded reconciliation engine, which automates end-to-end cash reconciliation for businesses. This offering aims to enable businesses to track and confirm their transactions as they happen. Paul, From what you have read or heard about modern Treasury's reconciliation engine, what do you think of its solution capabilities from a corporate treasury perspective?
I think this is the direction that everything's moving towards. Do things quicker and faster. So as payments are becoming faster and faster, moving from, hey, we could do wires same day, we could do ACHs 3 days later, to we can execute real-time payments. FedNow coming out with their platform. We're talking about instant payments, 24/7, 365 days a year. All of a sudden, the speed at which all this is happening is quicker. Reconciliations used to be, hey, this is something we did every month. We do this once a month. We do a reconciliation. We would find errors at that time, and that was acceptable at a time. And now the norm is we do daily reconciliations. Typically, when we say daily, it's a 1-day lag. So it's not happening today, even though payments happen today. It's the next day that's happening. When you see an offering like this, it becomes really appealing for organizations that are embracing this idea or this process of we're going to do things a lot faster. And if you're going to do an instant payment, to be able to reconcile it instantly as well, I think is going to be really beneficial to organizations that need to monitor and track the activity to ensure that they don't have fraud. They don't have something going out the door that they don't want to. So I think the use of this technology, I think, is going to become more prevalent as we continue to move forward. Integration with payment processors like Stripe and WorldPay, or with the banks, there's lots of banks that they're partnering with, I think is going to be super helpful. The use of machine learning, AI. I know there's been a lot in the paper around artificial intelligence, but with the right controls, AI is going to be super beneficial to a platform like this. Reconciliation is going to move from not daily 1-day lag to today we're going to reconcile, but not only reconcile today, as soon as we make a payment, we're going to reconcile that. So I think that's the direction or the natural evolution of what we're seeing out there in terms of payment and accountability.
I agree with that. The issue I have with this offering is that it says they are starting with Stripe and then covering huge companies like WorldPay, Adyen, and so on. They aren't there yet, and that's what auto-reconciliation has a problem with, is that they're not there yet. As a corporate treasurer, if I had a lot of my payments going through WorldPay and Adyen and others, and they're not covered in this system, so how do I use it? How do I manage that gap? That's the first problem with automated reconciliation, is there are always going to be gaps. And the second thing is how to manage the gaps in an evolutionary way. So as you pick up a new payment system, then you can increase your auto-reconciliation. Auto-reconciliation is here and it's coming more and more, but you have to manage it. It's not a done deal. You have to manage the implementation.
Yeah, no doubt, Jack. I think that's an important part because, they've got some processors, some banking partners. It's not the complete gamut of everything. It is a step forward. And to your point, you still got gaps. You got to manage those gaps. How that gets done, you're going to have really good processes in place. You're going to have people who are on top of things to manage the exceptions. I think over time it'll get better, but certainly, as a first step forward to this instant reconciliation or daily with instant reconciliation, it's a promising start. Much more to come.
I'd add a final point is that this is just another example of where Treasury is becoming more and more a manager of technologies, solutions, rather than just a single solution. It's managing the gamut of all the solutions together, and it will always be imperfect, but you're having to manage and improve as you go along.
Yeah, no doubt. That's an uber important point there, Jack. Treasury, as I knew it decades ago, was blocking and tackling. We could get cash from point A to point B. We can manage our bank accounts. And that was the extent of what you did. You may have did some journal entries as well, but you really didn't do much beyond that in Treasury. And Treasury today is so much further advanced, and technology is such an important part of where Treasury is heading, and the demands on Treasury have increased, and the use of technology has come along with it. So it's definitely a different ballgame.
Definitely a different ball game, and as you said, it'd be important. It's an important first step, but it would require managing the gaps. The next story that merits discussion is about European and Asian corporates requesting their banks for enhanced ESG service and advice, including ESG regulation, as well as other forms of practical support to help them sustain and grow their businesses amid growing economic headwinds, according to a new report from Coalition Greenwich. Jack, my question to you is, what do you think of this development from a European and Asian treasury perspective, wherein corporate banks are acting as partners to companies as educators and advisors on ESG?
The problem with this survey is that banks are multifaceted, different, essentially huge companies all brought together as a bank. Some parts of the bank are still lending billions to the oil producers, and other much smaller departments are running ESG advice to corporates, which is essential. The problem, though, is we've got the two together, and they really need to sort themselves out. That's my first point. The second point is that you can't manage ESG unless you fully understand the different regulations and the different methods by which it's managed. And that's where bank ESG departments are having an important role in helping corporates. But don't forget that overall, the banks are still funding the oil industry. We have to conquer that as well as do the ESG. It's not just ESG only. It's the overall contribution is what needs to be managed, not just ESG.
Certainly, lending to oil companies by banks, that's not going away anytime soon. The only way that goes away is dependency on oil and use of oil goes away. The point that goes away, we have alternative sources that we can utilize for or are covered under ESG. That's the point where, we can decouple that, but that's definitely an important point. What I noticed out of this survey, I was expecting more comments around ESG, and ESG is, to your point, Jack, around the regulations and so forth. I think it is a very difficult thing for many companies to manage. You'll see that they'll go out there and they'll start contemplating, hey, I want to make sure that I'm doing things in my organization that support ESG. How do I do that? They start getting into it. I think they start understanding that it's much more complex than what they anticipated. It's not as easy to do that. And so they're going to sources, and banks are a natural source for them for advice. In this survey, we talk about all kinds of things that aren't tied to ESG, but are equally important to organizations. So I was trying to figure out in this article, is it more about advice or is it around ESG? Because I couldn't bifurcate the two of them. It wasn't clear to me. So I think organizations are definitely looking for this. Hey, how do I enhance my customer service? What are practical forms of support? What does that look like? Especially in today's economic environment, that's becoming really important to them. And compliance, regulatory compliance, documentation, all that stuff that they talked about in this article here. These are things that companies are facing on a constant basis. So then when they jumped into the ESG it became a little disjointed to me, but it got me to thinking about, well, in Europe, it says here 60% of large companies have adopted ESG goals, and half of corporates in Asia have adopted ESG goals. If corporations adopt ESG goals, my question is about action. What kind of action is being taken? Even though you adopt goals, you can adopt goals, but what actions are being taken? What are the outcomes? Are you benchmarking that? And are you tracking how you are doing against these goals? Because I don't think ESG is as easy as many think that it really is. I think it's far more difficult. Several years ago when it was a hot topic and everybody was talking about it, banks do seem like a natural source to go to. But to Jack's point, there's conflict of interest there.
I'd like to come back on that. I think the point you make about actions, not just goals, is fundamental here. And that applies both to corporates and to the banks. All very well having highfalutin goals. Even BP has ESG goals, but they're meaningless given the rest of their business. So it's goals plus actions.
So the useful thing to remember here is goals plus action as well as conflict of interest. Those are great insights. Our next news item for discussion revolves around red flags re-emerging in the US corporate bond market. Last month's banking failures means a technical tidal wave may be coming for the biggest slice of the US $10 trillion market for corporate bonds, according to TD Securities, whose analysts predict that banks' collective higher cost of funding will curb appetite for higher quality credit and eventually force risk premiums to rise. Jack, if you were a US corporate treasurer, would you be concerned that the likelihood of rising risk premiums may cause a correction in the investment-grade corporate bond market?
I think it's inevitable. It's just the structure of the industry. The question that I think corporate treasurers have to address is, how do you overcome the lack of attractiveness of your corporate bonds? Is it by increasing your rates? Is it by increasing the way you make them available? Do you make them available in smaller portions? This has to be managed. You can't just sit and wait for your demand for your corporate bonds to disappear. You have to manage this, and it needs to be done in a number of different ways.
Yeah, thinking about this article here, there's, kind of two sides to this that I think about from a corporate treasury standpoint. One is, my cost of capital and how I access capital and what that cost looks like. When I issue a bond, do I issue a bond that is tied to interest rate movements? Do I issue it at fixed? What's going to happen to that bond after I issue it? What's that look like? The flip side to this is if I put on my old insurance hat, I've worked for several insurance companies, and insurance companies are liabilities plus assets on the balance sheet. The assets being they are taking premiums received. They're investing those premiums to generate a return, hopefully greater than the amount of interest plus principal that they pay out to insurers for various things, whether it's property casualty or whether it's life insurance, like annuities. You're trying to generate a return greater than the cost of the funding, which is the products that you produce. When you invest in bonds, you are susceptible to interest rate risk for sure. And we've seen a rise in rates as interest rates rise, bond prices fall, the value of your portfolio falls. If you're in a position where you had to sell something in the event of outflows outpace what's anticipated, you might have to sell things at a loss. So certainly get concerned about, this is a long-winded way to say get concerned about, interest rates rising in the value of the bond portfolio. So we saw that with SVB. They had a lot of interest rate risks in their portfolio. and customers lost confidence in the bank. And it's the worst thing that can happen to a bank. So if I'm a bank, losing confidence means I'm done for, because they're not looking at your balance sheet. They're looking at whether they can trust you with their money. If they don't trust you, they pull it out. That's what happens. You get a run on the bank and they pull out those deposits, and that kills the bank.
This article was basically about the dynamics of the capital markets, and it finishes by saying liquidity providers require sufficient margin to beat their internal funding costs. That's the name of the game, and this hasn't changed. The fact that SVB has gone broke hasn't changed the basic dynamic of the corporate bond market. It just means that a significant proportion of the corporate bond market source from banks has disappeared or has decreased significantly. But the dynamics of the corporate bond market is basically the same.
Yeah, spot on.
Couldn't agree more. Finally, what is your choice for the biggest or most important story of the past week, and why? Paul, can I ask you to answer that first?
I'm not a political junkie, but Joe Biden has announced that he's running for president again. That's a big deal. What I think is important that came out, though, is we had the fraud report come out, the survey from AFP. My hope is that corporations that read this really take to heart that they need to focus on training for their people, that they need to have something that's on a regular cadence and basis, and that it's disseminated throughout the organization, not just the Treasury folks, but throughout the organization for anybody who could potentially touch a payment, in that people really take to heart that they need to support their employees in bringing forward anything that doesn't seem like it's right, something that feels wrong or doesn't look right, doesn't smell right, seems like it's out of place. The sooner people do that, the bigger opportunity they have to recover cash. And let's face it, fraudsters aren't going away. They work 24/7, 365 days a year. So we're sleeping, they're working. They're looking for angles and ways to steal our cash. Well, let's stop them from doing it by putting into place a program like Secure Treasury or something like that, where you're training your people, focus on fraud, prevent it.
For me, there are two things from this podcast. One is that the importance of technology for Treasury is increasing all the time. The auto-reconciliation, the need for fraud management technologies that really pick up all the different pieces. That's one driver, that technology is becoming more important rather than less important. The other is that corporates need to look holistically, treasurers need to look holistically, not just at this solution, but say, for example, modern Treasury, that solution, but wider than that. Similarly with ESG, you need to look wider than that. You need to look at the overall impact of the bank as a whole. And so similarly, treasurers need to look wider at and become more cognizant of the overall nature and overall impact of what they do, because it's far greater than most people realize.
Those make a lot of sense. Jack, the keyword being holistic is extremely important. And Paul, your recommendation for payment security, focused payment security training via courses like securetreasury.com, particularly interdepartmental training, those are very useful thoughts. Thank you, Paul and Jack, for your informative analysis and precious insights. We would also like to thank our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.